Hi, I'm Noah Solomon, Chief Investment Officer of Outcome Metric Asset Management, and today I'm going to discuss how to measure skill when it comes to investing. So today I'm going to challenge conventional market wisdom. Most investment managers will tell you, one, that markets tend to go up over the long term, and two, you should sit tight and not do anything through bear markets because eventually you will recover those bear market losses and go on to see greener pastures and bluer skies. And this is the way most money is managed. Chances are if you have an investment manager, that's how they run your portfolio. They don't make any significant changes regardless of market environment. So whether you are in the throes of the awful bear market of the global financial crisis of late 2008, or in the midst of the rip-roaring recovery of late 2009, they don't make any significant changes to your portfolio. Whereas I agree with the first assertion that markets do rise over the long term and that bear market losses do get recovered and you do go on to erase those losses and make new gains, that does not mean, and I do not agree with the second assertion, that you should just sit tight and be inert and ride bear markets all the way to the bottom. This is because volatility is like a virus. It's like a virus that infects your portfolio and damages your long-term returns. And I can illustrate how volatility impacts your portfolio in the following example. So in this example, I have a theoretical $1 million investment. And the $1 million can be put in one of two portfolios. The first portfolio is what we call the high volatility portfolio, and the second portfolio is what we call the low volatility. They both, over 4 years, have two round trips. The high volatility portfolio goes down 30% in year one, up 30% in year two, down 30% in year three, and back up 30% in year four. The low volatility portfolio, true to its name, has the same round trips but with much less severe magnitude or swings. So in the first year it declines 5%, in the second year it recovers 5%, in the third year it declines 5%, in the fourth year it rises 5%. Now here's a really interesting observation. Over the 4 years, the sum of returns of both portfolios is zero. The high volatility portfolio, down 30, up 30, down 30, up 30, zero. The low volatility portfolio, same thing, down 5, up 5, down 5, up 5, sum to zero. But despite the fact that they have the same sum of returns of zero over 4 years, they have markedly different values at the end of year 4. The high volatility portfolio, your $1 million investment at the end of year 4, is only worth $828,100. In other words, you've had a loss on your $1 million investment of over $171,000. The low volatility portfolio, despite having the same sum of returns, has a value of $995,000, so a loss of approximately only $5,000. So same sum of returns, but wildly different values at the end of year 4, with the low volatility portfolio have a much better result, or certainly a much less worse result. So why is that? It's because of the way compounding works. If you look at the chart or the table, after a 30% loss for the high volatility portfolio, a 30% subsequent gain does not erase the 30% loss. So after a 30% loss, $1 million is down to $700,000. Then after the 30% recovery in year 2, you're at $910,000. So you've still suffered a $90,000 loss. So a 30% gain doesn't wipe out or anywhere near wipe out a 30% loss. Now let's look at the low volatility portfolio. After a 5% loss, the $1 million investment is worth $950,000. After the 5% gain, it's back to $997,000, so only a $2,500 loss. So you can see how volatility, even though with the same sum of returns, how volatility is like a virus that really is detrimental to your portfolio. Now I'm going to give another example. So if you look at this table, it's the same as the previous table, except I've added a 5th year. And the 5th year is a good year. So true to its character, in the good times, the high volatility portfolio rises 20%. The low volatility portfolio, true to its character, has a much more modest gain of only 2%. But again, let's look at the values at the end of year 5. Now, the high volatility portfolio, by the way, has a sum of returns of 20% over 5 years, whereas the low volatility portfolio have a sum of returns of 2%. So clearly, when you add up the returns, the high volatility portfolio looks much better, 18% better than the low volatility portfolio. But now let's look at the actual dollar values again. So at the end of year 5, despite having a sum of returns of 20%, the high volatility portfolio is only worth over $993,000. You're still underwater. You still have a loss, albeit a modest one. On the other hand, the low volatility portfolio, with a sum of returns of 2%, a full 18% lower than the high volatility portfolio, actually has a gain. It's worth $1,014,000. It has a gain of almost $15,000. So here's an example where sum of returns of 20% for the high volatility portfolio, still in a losing position. Sum of returns for the low volatility portfolio of 2%, not in a losing position, having a small gain. So once again, you can see, even when the sum of returns isn't the same, even with a higher sum of returns, the high volatility portfolio is worth less at the end of the day than the low volatility portfolio. I want to point out one more aspect of how volatility can really be detrimental to your financial health. In this example, I want to point out how one large loss can wipe out several good years. So in this case, I have a 5-year example, again based on a $1 million investment. But in this case, instead of having round trips of down, up, you have 4 good years, a bull market of 4 years, followed by a bear market in the 5th year. So looking at the high volatility portfolio, in the 4 good years, the first 4 years, it gains 15% each year. So pretty good, 15% each year. You know, the sum of returns is 60%. In the bear market year, in year 5, it gets killed. It has a 48% loss. So its sum of returns is 12%. Now let's look at the low volatility portfolio. True to form, in the 4 good years, instead of being up 15% each year, it's up only 5%. So after 4 years, you've got a sum of returns of only 20% as opposed to 60%. Now, true to its character again, in the bear market, in year 5, instead of losing 48%, it loses 15%. So it has a sum of returns of 5% compared to the 12% for the high volatility portfolio. Now let's go to the actual dollars again. The high volatility portfolio is in a loss position. At the end of year 5, with a sum of returns of 12%, it's worth about $910,000. So you still have a loss of approximately $90,000. The low volatility portfolio that only went up 5% a year in the good times in the first 4 years is still in a winning position with a gain of $33,000. It's worth $1,033,000 at the end of year 5. So you can see that with the high volatility, one large loss can wipe out years of gains, whereas the low volatility portfolio is much less exposed to that phenomenon. And we know that happens. Bear markets have happened, and they will happen. I'm pretty sure they're going to happen a few times again in our lifetimes. So they're always a question of if, not when. So you understand how even a portfolio that looks great in the good times is really exposed to that bad year that will eventually come and has and will again. So I want you to think back to late 1999. The markets have been on a tear. It's the tech bubble, and life is good. Britney Spears, Ricky Martin, and Cher are topping the charts, and it seems like the party is never going to end until it did. And then you had a bear market where stocks dropped about 50%. So you can see what happens to the high volatility portfolio. Or a more recent example, imagine it's mid-2007. The iPhone just got invented, the markets are rosy, and just as things seemed like they couldn't get any better, they didn't. And again, you had another near 50% drop in stock markets. So we have seen bear markets. We will see them again. And we see what that does to high volatility portfolios. They wipe out years of gains as opposed to the lower volatility portfolio where they can actually hang on to some gains when those bear markets happen. So this illustrates the importance of mitigating volatility and avoiding large bear market losses. So beware of any manager who tells you how good they've done in a bull market unless they also show you or can demonstrate that they can manage the volatility and the losses in a bear market. Excessive volatility is like a virus that infects your portfolio and damages your long-term returns. Remaining passive by just hanging in there and riding through bear markets simply because eventually markets go up over time and you'll recover your losses is not a good idea. It is detrimental to your long-term results. So you can see how risk management, specifically mitigating volatility and avoiding large losses in bear markets, is essential to achieving superior long-term returns. At Outcome, that lies at the foundation of how we invest. We use machine learning-driven, data-based investment models to mitigate volatility, avoid large losses so that our clients can achieve superior long-term results. Thanks for watching. If you want to learn more about outcome metric asset management and our investment strategies, please visit our website at outcomewm.com, where you can receive our contact information and sign up for our monthly newsletter.